Moving now to the next reading, fixed income markets, issuance, trading, and funding. Classification of fixed income markets. Fixed income markets can be classified along several different dimensions. One major dimension is the type of issuer. So you will see a category called sovereign bonds. So you can have countries such as the United States issue their government bonds, Germany will issue their government bonds. So that's one type of issuer. You can have supranational bonds issued by entities such as the IMF and World Bank. You can have corporate bonds issued by various corporates around the world. So one categorization or classification is based on issuer. Then you can also have a classification based on credit quality. And with all these classifications, there can also be sub-classifications. You can have investment grade bonds where the rating is BBB and better. You can have what's called junk bonds or high yield bonds with a rating that is below BBB. Within investment grade, you can have a category of companies that are AAA rated, category of companies that are A rated, and so on. So you can have a classification based on credit quality. You can also have a classification based on maturity. So you can say that these are money market instruments where the maturity is less than a year. You can have a classification called long-term bonds where you say that the maturity is greater than 10 years, and so on. You can have a classification based on type of coupon. The most basic distinction would be between fixed rate bonds versus floating rate bonds. Floating rate bonds have a reference rate. That reference rate depends on country to country. So one of the most popular reference rates is LIBOR, the London Interbank Offer Rate. In different countries, there will be other comparable reference rates. Now, just understand in terms of the Interbank Offer Rate, which is what this stands for, interbank offer rates are sets of rates that reflect the rates at which banks believe they could borrow unsecured funds from other banks in the interbank market for different currencies and different maturities. And the reason we say sets of rates, because you take a particular currency like the dollar, then the borrowing can happen for different periods. So there is a different 30-day LIBOR, there is a different 60-day LIBOR, and so on. So keep this in mind. And notice that LIBOR is a private market concept. It is the rate between private banks. You can also have a classification based on currency. So you can say dollar bonds or euro bonds or yen bonds and so on. A classification based on geography, or there could be other classifications. But the ones that we've talked about here are the most important ones. Fixed income indices and fixed income investors. We've talked about this in the reading on indices, but very briefly, a fixed income index is a multi-purpose tool used by investors and investment managers to describe a given bond market or sector, as well as to evaluate the performance of investments and investment managers. I'll not say much about this here because we've already talked about indices, and that included a discussion on fixed income indices. Now, who are the major investors? Major categories of bond investors include central banks, institutional investors, and retail investors. Central banks and institutional investors generally invest directly. So this means that if you are a large institution such as Goldman Sachs and you are buying bonds, then you will buy the bonds typically directly. Retail investors generally invest through mutual funds. So retail investors means individual investors. You will not go directly buy a bond for yourself. If you want to invest in the bond market, typically you will invest in bonds through a bond mutual fund, a money market mutual fund perhaps, or through exchange traded funds. Central banks use open market operations to implement monetary policy. This is something you saw at level 1 economics and to some extent in level 2 economics. So central banks do a lot of buying and selling of their government securities. Institutional investors are the largest group of investors in fixed income securities. Retail investors also invest because they like the price and income stability generally associated with fixed income securities. Primary and secondary bond markets. Primary bond markets are markets in which issuers first sell bonds to investors to raise capital. We can either have an underwritten offering or a best effort offering, and this is quite similar to what we've seen in equity. With an underwritten offering, an investment bank buys the entire issue and takes the risk of reselling it to investors or dealers. So the risk then is transferred from the issuer to the investment banker. In a best effort offering, the investment bank serves as a broker and sells the bond issue only if it is able to do so. In this scenario, the risk is with the issuer. Secondary bond markets are markets in which existing bonds are subsequently traded among investors. Securities are traded among investors in the secondary market. Secondary markets can be structured as organized exchanges or as OTC market. Most bond trading happens in over-the-counter market. So there is a network of dealers, and those dealers buy and sell. The bid-ask spread reflects the liquidity of a market. If the bid-ask spread is narrow, that means that there is lots of liquidity. If the bid-ask spread is wide, that means that the liquidity is low. Government bonds, quasi-government bonds, and supranational bonds. So government bonds that are issued by the central government or the federal government are called sovereign bonds. Generally, there is little or no credit risk if denominated in local currency. So if a country such as India issues bonds in its own currency, then the credit risk is considered extremely low. However, if a country issues bonds in another currency, which it cannot print itself, then obviously the credit risk can be high. And we'll talk more about credit risk and assessment of the credit risk of sovereign bonds later. You need to know this term, on the run versus off the run. When a given country issues bonds, the bonds that have just been issued are referred to as on the run issues, and those that have been issued a while back are referred to as off the run. Generally, there is a preference for on the run issues. Those tend to be more liquid. If maturity is less than a year, then the instrument is called a pure discount instrument. In most countries, when the government bond is less than 1 year, it's called a treasury bill. So in the United States and Pakistan and several other countries, you have these instruments called T-bills. And with T-bills, they are quoted on a discount basis. And we talked about that in quant. We'll talk about it again later in fixed income. You can also have non-sovereign government bonds. These are bonds issued by states or provinces or municipal authorities. And here the credit ratings can vary. And then you can have bonds issued by quasi-government or semi-government entities. These are also called agency bonds in the United States. Popular agency bonds in the US include bonds issued by Fannie Mae and Freddie Mac. Agency bonds generally rely on cash flow generated from their own operations, not from taxes. Sovereign bonds will typically rely on taxes. Agency bonds often have government backing, but this is not necessarily always the case. In some countries, you might have agencies that issue bonds without the government backing. And then we also have supranational bonds. These are bonds that are issued by entities such as the IMF or the World Bank. Corporate debt. Previous slide talked about governments of different forms. Now we are talking about private companies. Some important terminology that you need to know. A bilateral loan is a loan from a single lender to a single borrower. A syndicated loan is a loan from a group of lenders called the syndicate to a single borrower. So just know this terminology. Most bilateral and syndicate loans are floating rate loans. For highly rated companies, both bilateral and syndicated loans can be more expensive than bonds issued in financial markets. So this is saying that if you are a company with a good credit rating, let's say a AA rating, then it is more cost effective for the company to issue bonds than it is to go to a bank. But this actually varies from country to country. In some countries, it might actually be more feasible to go to the bank where the bond market is not heavily developed. So I would say that this remark here is more related to countries with developed bond markets. Commercial paper is a short-term unsecured promissory note issued in the public market or via a private placement that represents a debt obligation of the issuer. Commercial paper is a valuable source of flexible, readily available and relatively low-cost short-term financing. It is generally used for working capital and seasonal demands. So you will not borrow short-term using commercial paper to build a new plant, but you might borrow short-term to meet a working capital requirement. Sometimes this is also called bridge financing. The yield on commercial paper is greater than the yield on short-term sovereign bonds. And this makes sense because with commercial paper there is credit risk, and because of that credit risk the investor will get a higher return relative to the return on a government bond. Corporate notes and bonds, so we are still in the corporate sector. You can categorize corporate bonds based on maturities. You can have short-term maturities, so the commercial paper that we just talked about would be short-term. You could have long-term bonds, typically 10 years or longer, or you could have medium-term bonds. Then there is this category called medium-term note, where medium-term note is a misnomer because medium-term notes can be short-term, long-term, or even medium-term. But from a testability perspective, the key point related to medium-term notes is the following. These are offered continuously to investors through agents of the issuer. So what happens here is that the issuer works with an agent and in a sense gives the agent these bonds, the MTNs, and then the agent is the one that is selling the bonds to the investor. And because of this agent in the middle, there can be a continuous flow of medium-term notes. This is not covered in detail in the curriculum, but very often these medium-term notes can have complicated structures. You can have different coupon payment structures. So very simplistically, a company can issue either fixed rate bonds or floating rate bonds. And we've already talked about the different kinds of floating rate bonds. Principal repayment structures. We can have serial maturity, where maturity dates are spread during the bond's life, or term maturity where the notional principal is paid at maturity. Asset or collateral backing. When a bond is issued, there might be asset or collateral backing, and that will be specified. There can be contingency provisions, and the major provisions that you need to remember are callable bonds, puttable bonds, and convertible bonds. Issuance, trading, and settlement, we've touched on this before. Generally, bonds are traded in the over-the-counter dealer market. Dealers earn profit from the bid-offer spread, and generally the settlement is T+3. Structured financial instruments represent a very broad sector, but based on everything that I have seen and read, I have seen almost every instrument other than a regular bond be referred to as a structured instrument. So asset-backed securities are structured instruments, collateralized debt obligations are structured instruments, mortgage-backed securities, which are actually a subset of ABS, are also structured instruments, and these instruments are discussed in other readings. The sorts of structured instruments that we focus on in this reading are shown right here. So we will understand these four categories with examples. Let us start with capital protection instruments. Say an investor has $100,000 to invest and he buys a government bond. So this is a bond with no credit risk, which pays a par value of 100,000. And the value today of this bond is 99,000. So he'll pay 99,000 and after 1 year he will get 100,000. He can then take the remaining 1,000 and use this money to buy call options on some stock. Now notice what happens. He invested a total of 100,000 and his return here is guaranteed in the sense that he has preserved his capital. That's why we say this is a capital protection instrument. But at the same time, since he has bought call options, he also has upside potential. If the underlying stock goes up, then he makes a lot of money based on these call options. Now, the example that I gave here can also be called a guarantee certificate because this structure ensures that at the end he'll get at least 100,000, which is the investment amount. Obviously, capital protection instruments can be set up to offer different levels of capital protection. Next, we come to yield enhancement instruments. And a classic example of a yield enhancement instrument is a credit-linked note. So say we have an issuer who issues a credit-linked note and an investor buys this credit-linked note. The credit-linked note can be thought of as a bond which is tied to an underlying asset. This underlying asset is called a reference asset. Now, this credit-linked note is like a bond which will make regular coupon payments, and then the final par value payment will depend on whether a certain credit event has occurred. Say the credit event is defined as a downgrade of this particular reference asset. If that downgrade happens, obviously the value of the reference asset is impacted, and that in turn has an impact on the par value which is paid. If there is no credit event, then the investor is going to get the regular coupon payments and the regular par value. If there is a credit event associated with this reference asset, then the par value received at the end is lower. Now notice in this setup, the investor is taking on the credit risk of this reference asset. So that's the risk being taken. What's the return? The return is in the form of relatively high coupon payments. Credit-linked notes will have higher coupon payments compared to otherwise similar regular bonds. Also, credit-linked notes are likely to sell at a discount. So in addition to the relatively high coupon payments, there is also going to be a capital gain as long as there is no credit event. If you have studied credit default swaps, then this will look familiar because in essence, a credit-linked note is a combination of a bond and a credit default swap where the issuer is buying the protection and the investor is selling protection. If you did not understand the part about credit default swaps, don't worry about it too much. The core point is that with yield enhancement instruments, the investor is taking on more risk, specifically more credit risk, and is being compensated with a higher return. Participation instruments. Such instruments allow investors to participate in the return of an underlying asset. The classic example here is of a floating rate bond. With a floating rate bond, the investor benefits if the interest rates go up. So in essence, the investor is participating in interest rate movements. When the interest rates go up, the investor will receive a higher coupon payment. Many participation instruments are designed to give investors indirect exposure to a particular index or some asset price. The final category we need to study is leveraged instruments. These are structured financial instruments created to magnify returns, and these instruments offer the possibility of higher payoffs from small investments. A classic example here is an inverse floater. With an inverse floater, the coupon payment is inversely related to some reference rate. So the inverse floater coupon rate is generally based on this sort of formula. It is C minus L times R. C is the maximum possible coupon rate possible. R is the reference rate, and L is the coupon leverage. So let's take an example given in the curriculum where they say that at some point the Royal Bank of Scotland issued inverse floaters based on a formula of 8% minus 3-month LIBOR. The leverage factor there was 1. Now in this case, if LIBOR goes down, then the coupon rate or the coupon payment goes up, because as LIBOR goes down, then 8% minus a smaller LIBOR gives us a higher number. On the other hand, if LIBOR goes up, then this number will come down. The L, as I said, is leverage. If the leverage is between 0 and 1, then this is called a deleveraged inverse floater. On the other hand, if L is greater than 1, then we would call the instrument a leveraged inverse floater. Inverse floaters often have a floor that specifies a minimum coupon rate. For example, a floor may be set at 0 to avoid the possibility of a negative interest rate. Short-term funding alternatives available to banks. Now imagine you are a major bank. How do you get your funding? There are 3 primary categories. Retail deposits, and this is what banks like the most because this is the lowest cost form of financing. This is where your regular depositors come and give money to the bank or deposit money in the bank. Then the next category, which is expensive, is short-term wholesale funds such as central bank funds. This is where the bank borrows from the central bank. Remember, in economics level 1 you studied that the central bank is the banker to the banks. Or through interbank funds, which means you borrow from other banks, or certificate of deposit. A CD can either be negotiable or non-negotiable. With a non-negotiable, the CD cannot be resold, but a negotiable CD can be sold to another investor. And finally, what I think is most testable is repos and reverse repos. The long name is repurchase agreements and reverse repurchase agreements. Obviously, in the regular lecture, there is more detail on this, but here I've tried to capture what is most important. A repurchase agreement or repo is the sale of a security with a simultaneous agreement by the seller to buy the same security back from the purchaser at an agreed on price and future date. Now, obviously, in this repo agreement, where let's say that I am agreeing to buy back a certain security from you at a later point. So I'm getting some money today for a given security, giving you that security, and I'm saying 3 days later I will buy it back. Obviously, the rate at which I'll buy back will be higher than the money that I am getting today. So this is collateralized borrowing, and there is a rate built in based on how much I'm getting from you and how much I'll pay back. So what do those rates depend on? They depend on the risk associated with the collateral, the term of the repurchase agreements. Generally, the longer the term, the higher the rate. Delivery requirement. So is that collateral actually delivered or not? Supply and demand, and interest rates of alternative financing. Now, these are points that have more details, but I think from a testability perspective, knowing this should largely cover you. Each market participant is exposed to credit risk. Who are the market participants? So one party is doing the repo, the counterparty is doing the reverse repo. So both are exposed to credit risk. But the way these are structured, the lender has greater exposure to credit risk. And the final point that I'll emphasize here is that there will often be a difference between the market value of the collateral and the value of the loan. That difference is called the repo margin or the haircut.